I've been hearing a lot of people talk about foreclosures lately and how excited they are to get a deal on the clearance rack. Yes. But what happens if interest rates go from the historic lows where they are now back to, say, 1 point higher where they were less than a year ago? Let's talk about that. Thank you for watching. This is your weekly market minute that is guaranteed to be more than a minute and bring you the facts about what's going on in real estate locally here in the Denver market, plus a little bit about what's going on nationally. Today we're going to be talking about how does interest rate affect your buying power. Today, rates are hovering in the low threes. This is historically low, down about 1% from where rates were last year at this time. So we can thank these low rates for the lopsided relationship between supply and demand, and why so many homes are seeing multiple offers shortly after going on the market. Now, that said, it's perfectly natural that conversations about foreclosures will become more abundant in any shifting or uncertain real estate market, which we have ourselves today. No question about that. But what's more likely than seeing a huge wave of distressed homes make their way to market, or even a substantial decrease in home prices, is an increase in interest rates. In other words, the money you need to buy a home will become more expensive. So what people don't always take into account is that the interest rate that the buyer qualifies for has a larger impact on affordability than actually waiting for the prices to fall out. So I'll illustrate this point with this slide provided by Megan Aller at First American Title, who I rely on for many of the trends that I report on and bring you. So feel free to pause this video at any time to study. It's pretty mind-boggling what the power of interest can do. So the calculation considers a home just under the average price point for a detached home in Denver. So let's call it $500,000, as you can see. The pyramid on the left is the same data visualized as the table on the right, which maintains the same monthly mortgage payment of $2,245. So say you're purchasing a home today and your loan is $500,000. Your mortgage is $2,245, and when you have an interest rate of 3.5%, about where things are today. So now let's say that by fall, as the economy hopefully is in a better position than it is today, rates start to increase or creep up. Let's say it increases by only 0.5 point. To maintain the same mortgage, your new loan amount has decreased by almost $30,000. Increase rates to where they were summer 2020, around 4.5, and your buying power that was once $500,000 is now over $56,000 smaller. So this may mean the difference between the neighborhood you love and the neighborhood that you weren't as excited about. So now, I'd also love to note that I don't have a crystal ball, and I don't know what's going to happen to interest rates or foreclosures, but what I do know is that I am committed and will continue to provide you with the facts and the trends needed to make smart real estate decisions. I'll talk to you next week. Thanks for tuning in. Take care.